One question that comes up regularly is term deposits versus superannuation. And should I withdraw my superannuation and put it in the bank? And I think Ross asked the question, should I invest in managed funds or term deposit? Is the stock market ever going to improve? The stock market will improve, but the expectation that we should have, and people like the Governor of the Reserve Bank, Glenn Stevens, is, I guess, championing the message that we should expect lower levels of return than we have in the past couple of decades. The average return per person over the past couple of decades was 6% return. Now, he's suggesting that we should be expecting half of that in terms of per person return in terms of economic growth. So a 3% return. So whilst the returns may not be as high as they were in the past, we can expect the markets to, start to perform into the future. Whether that's going to be right now or whether that's going to be in a year or 18 months or 2 years, I can't say, nobody can say, but markets will return. So the question here is, should I be in a term deposit or should I be in superannuation? Now, key points to consider. Firstly, that superannuation is not an investment itself. You can be in superannuation in a term deposit. In Christian Super, that is the ethical cash option. They're effectively investing in term deposits on your behalf. One of the benefits of investing through a fund like Christian Super and investing with a group of people in term deposits is that you don't have the maturity risk. So if you actually took your money out of superannuation, put it in the bank and earned 4 or 5%, you're locking your money away for 6 months, so you can't actually touch that money. You're locking away for 6 months, you can't touch the money, or you might pay penalties if you can touch the money. Whereas within a superannuation fund, you can be invested in those term deposit type investments, but if you need your money, you can sell out and the fund will work out having enough cash flow to actually pay you out. So there are this is basically a list of pros and cons of investing in term deposits in your own name versus investing within superannuation. A key one is tax, like we talked about earlier. If you are not of pension age and are still working, you're on a marginal tax rate of 30%, then pulling money out and putting into a term deposit, earning 5% and losing a third of it, doesn't make sense. You also need to factor in the Social Security or Centrelink effect of pulling money out of superannuation and investing it. If you have got other income, so you're working part-time or you've got an index pension through another organisation or you're deriving some other income, then holding money within the pension phase of superannuation can mean that you can get a higher pension than if you held the funds in your own name, because Centrelink concessionally tests superannuation assets that are in pension phase. So it's another consideration before you go and pull all your money out of super. Risk is an interesting one. A lot of superannuation funds can't get the government guarantee on the investments within their cash option within their superannuation, whereas you can go and invest the money yourself in your own name and you can get a government guarantee with the institution. That means that if the institution you're investing with fails, the government will pay out your money. So that's one of the benefits of investing in your own name. You've got to look at the returns inside of superannuation versus outside of superannuation. What sort of return can you get inside super versus what sort of return can you get outside of super? Diversification. If you invest in one investment option in your own name, there's the risk of the return that you're locking yourself in for. When you're investing in a diverse group of investments and you're reducing the concentration risk and potentially able to get a higher level of return through that process. One of the key things to understand is your longevity risk, and we talked about that earlier. If you're in the cash or term deposits, will that provide for your long-term needs? And then secondly, if right now you're of pension age, you've decided to pull the money out of your superannuation fund, put in a term deposit, you've worked out that right now that's not going to affect my age pension, I'm still going to get the same level of age pension, but in the future you receive an inheritance, it may end up either impacting your age pension or it may end up impacting tax. You might end up paying some tax. So you need to factor in any further sort of windfall gains that you might actually receive into the future as well, because I often run into people who are in their 70s or early 80s and they're frustrated because they're paying tax on their earnings within their superannuation. And they can't do anything about it. They can't get money into the superannuation. They're frustrated because they're not paying tax on their money outside of their super, and they can't get money into the superannuation environment because they don't satisfy the work test. They can't get it into their super fund and get that 0% tax environment. So, well worth considering all those things when you're thinking about pulling your money out of super and putting it into a term deposit. But managed funds or term deposits, I would say, for Ross, a combination. If it's in your super fund, then being in one of those mixed options of between ethical stable to ethical growth, have a combination of managed funds and term deposit. That's effectively what those three options are.